Welcome and thank you for joining us. First, I would like to thank Solar Power World for hosting this webinar. Earlier this year, we hosted a series of webinars focused on domestic content, compliance for rooftop applications, providing education, guidance, and product updates in collaboration with Novogradac, SolarEdge, and Enstall. Today, we are excited to bring the team back with an expanded focus: domestic content compliance for carports and small ground mount projects. And this time, we're joined by Heliene, delivering a complete solution for your projects. Let me introduce everyone here. So my name is Kleber Facchini, Director of CC&I Products and Applications for SolarEdge North America. Liz Reichertz, Global Head of Government Affairs, SolarEdge. Josh Morris, Partner at Novogradac. Corey Geiger, Chief Operating Officer at Enstall. And David Rosenberg, Chief Commercial Officer at Heliene. We have an outstanding lineup for today's webinar, and we'll be diving into key topics that combine education with practical solutions to help you succeed. So I'll go through an introduction, then there will be a policy update from Liz, and we'll hear from Josh on how to calculate domestic content compliance using direct cost method and key considerations for FEOC calculation for carport and fixed ground mount projects. David will introduce Heliene and their modules, and then I'll explain the suggested model for carport and small ground mounts and provide an update on the rooftop model. Corey will close with an update on Enstall, and then we'll move into the Q&A session. Just as to introduce, right? So what are the concerns that we're hearing from the industry? Our goal today is to address three major concerns we're hearing from customers, especially those working on carport, small ground mount, and rooftop applications. Uncertainty around policy guidelines. The industry remains unclear about recent regulatory changes and the steps required to qualify for the investment tax credit and domestic content bonus rules. Limited availability of domestic content modules. There is a shortage of domestic content modules, particularly those using US manufactured cells. And complexity in alternative compliance methods. Pursuing alternative approaches such as the direct cost method to secure the domestic content bonus credit is challenging and resource intensive. So I'll pass now to Liz, and she'll give the policy update. Go ahead, Liz.
Thanks.
Thank you.
Thanks, Kleber. Happy to join this great panel. As Kleber said, I've been asked to kind of set the stage by providing the state of play on the policy side. So first, high level, H.R.1, the One Big Beautiful Bill Act, was signed into law on July 4th of this year. Treasury then released new guidance related to H.R.1 on beginning of construction that was effective on September 2nd, 2025. We're expecting additional H.R.1 guidance related to FEOC, but that's likely to be delayed a bit because of the government shutdown, along with some other priority guidance Treasury is working on. And then finally, new guidance or not, FEOC restrictions will come into play January 1st, 2026. Okay, let me quickly recap H.R.1 impacts for your 48E credits. H.R.1 both shortened the amount of years for 48 Cap E credit and changed the commenced construction timeline for the 30% base credit. Therefore, for projects that begin construction on or before July 4, 2026, they're eligible for tax credits under existing commenced construction guidance that allows the full 4 years to complete your project. However, projects that begin after July 4, 2026 must be placed in service by December 31, 2027 to receive the credit. For the domestic content bonus, H.R.1 fixed what we understand to be a congressional drafting error in 48 Cap E under the Inflation Reduction Act. So projects that begin construction after June 16, 2025 need to meet 45% domestic content instead of 40% to get the 10% bonus adder. And then there's a 5% increase after that. So in 2026, you'll have to meet 50% domestic content, and in 2027, 55%. The other critically important new requirement beginning January 1, 2026, in order to receive your credit is the Foreign Entity of Concern, or FEOC restrictions. And I'll cover this in a minute. Go ahead, next slide. Okay, great. Let me just touch on the new Treasury guidance, the IRS Notice 2025-42 that was released in August and then was effective September 2nd, 2025. The guidance confirmed the ability to use both the 5% safe harbor method and the physical work of significant nature test to begin construction for projects equal to or less than 1.5 megawatts AC nameplate capacity. However, for projects that are greater than 1.5 megawatts, taxpayers can only use the physical work test and not the 5% method to begin construction. The timing of when you commence construction using either of these two methods locks in the regulatory requirements at that time. So for example, if you were to safe harbor by beginning construction before the end of this year, you're locking in the 45% domestic content requirement for your project before it rises to 50%. H.R.1 also directed Treasury to provide certain FEOC guidance such as circumvention and anti-abuse. This was not included in this first notice, so we do expect additional guidance to come. Next slide. Okay, back to FEOC. Let me quickly break down what compliance means in practical terms. And as I said, we're waiting on the additional guidance from Treasury, so FEOC rules will evolve, but here's what we understand today. Let me start with some important terms. Foreign entity of concern is defined by Russia, North Korea, Iran, and China. So the focus here really is about restrictions on Chinese components. PFE stands for prohibited foreign entity. The definition of PFE includes both specified foreign entities and foreign influenced entities. These are all new terms defined in H.R.1. A PFE requires consideration of whether the entity has ties to a covered nation, which includes the People's Republic of China. For example, an entity incorporated under Chinese laws, to be clear, is undoubtedly an SFE, a specified foreign entity. So when you're dealing with your suppliers that have ties to Chinese entities, you would want to be certain, among other criteria, that, for example, there isn't less than 25% Chinese ownership, there's no authority to appoint covered officers, no contracts, agreements, or arrangements giving effective control to Chinese entities, and not holding significant debt or licensing agreements. To get your 30% base credit for projects that begin construction after December 31, 2025, you'll be required to calculate the non-FEOC percentage through what's called a material assistance cost ratio. And unlike domestic content, where all you have to worry about is whether you have US manufactured product components, under FEOC, you have to know whether your suppliers are PFEs, where the manufactured product components were manufactured, and get signed certificates. This slide is just meant to illustrate the point that if a manufacturer is a PFE, even if manufacturing in the US or another non-FEOC country, the MPC is still considered FEOC. So you need non-PFE manufacturers operating in non-FEOC countries to reach your non-FEOC percentage. The positive news is that while we wait for additional guidance from Treasury, prior to the new guidance and 60 days after, taxpayers can rely on the IRS Notice 2025-08, so that's the current safe harbor domestic content table, to calculate your non-PFE total. Now, let me turn it over to Josh to provide more information about how we can help you make these very complicated issues much easier. Josh?
All right, thanks, Liz. And that was a fantastic discussion there on the policy update and FEOC. Appreciate all of the acronyms and that you set the foundation so that way I can easily reference the acronyms without having to define them. So my name is Josh Morris. I'm a partner at Novogradac. I'm really excited to be here and join this webinar and talk to you all about the services that we provide for domestic content and for FEOC, and how we can help you all substantiate the compliance of these very complicated tax matters. And so before I dig into those tax matters, let me talk to you a little bit about Novogradac. Kleber, you can go to the next slide. So Novogradac is a CPA firm. If you haven't worked with us before, we're very well regarded and well known in the industry, and we specialize in helping projects that benefit from tax credits to work through the tax issues. We provide consulting and accountant style deliverables. I like to think about our service line as 6 different buckets within 2 different silos, if you will. And so the first silo would be the transaction advisory services that we provide. As a project closes a tax equity transaction, there are 3 key things that you need to do. You need to determine the ITC basis, determine the ITC rate, and then monetize the credit. We can help with each of those 3 things. For the ITC basis, we provide cost segregation studies, fair market value appraisals. Within the bucket of determining the ITC rate, we help with begun construction analysis, which is one of the most important things right now to consider and strategize around ensuring that you have a strong begun construction strategy, and we can help document that. We also help with PWA, prevailing wage and apprenticeship analysis, through the form of an agreed upon procedure report, and then also the domestic content adder. We provide that AUP report. Similar to domestic content, we're doing that analysis for FEOC. This is a new deliverable that we're providing the industry that helps work through the compliance matters there. We'll talk more about that in a minute. Then with monetizing the tax credit, we assist with tax equity structures, evaluating tax credit sales, and we provide financial modeling for stakeholders to analyze the after-tax economics to the deal. And then on the other silo, we provide ongoing compliance services for these tax credits. There are important tax filings, and we help with that. We help with the partnership tax returns, the various pre-filing registrations, and the tax forms that are needed to claim the tax credit. And then if you have a partnership arrangement, it's likely that your stakeholders might require a GAAP basis financial statement audit. We are fantastic auditors here, and we can help you with that and provide an efficient process there. And then ongoing compliance, we help with PWA, AUP reports, and FEOC AUP reports on an ongoing basis. As that compliance doesn't stop when you close the deal, you have to continue that compliance throughout. Okay, next slide, Kleber. Perfect. And so let's dig into the direct cost method. If you all joined our last webinar, we discussed that safe harbor approach. There are these 2 methods for substantiating the 10% domestic content adder. You have that direct cost approach, and then you also have the safe harbor approach. You'd love to do the safe harbor approach all day long. It's the simplified method where there are these default rates that you can rely upon and really just obtain and substantiate that the MPCs, or manufactured product components, are made in the US. The direct cost approach is a little more involved. It is a little more complicated. You have to actually obtain the direct costs of the manufactured products and figure out that domestic content ratio. Now, I'm here to tell you that it is more complicated, but there's a path in doing it that isn't overly complicated, and we have a quick illustrative example to kind of walk through with you here. And for carports particularly, okay, for carports that are direct cost calculations, sometimes is your only path to substantiate it. And so if you're attending this webinar, I don't want you to be so concerned about the direct cost approach. It is viable. And so how do we figure this out? You have to look at the manufactured product costs, and for the carport, that's really narrowed down to 2 main applicable project components. That's the module and the inverter. And each of those APCs has multiple components underneath, NPCs, and you have to obtain those direct costs. And so for this example here, let's assume that the solar cell is not made in the USA. Now, if you're familiar with the safe harbor tables, immediately you're going to have a hard time getting the math to work because the cell makes up such a big percentage of those default rates. Now, what we all have come to realize is, although the safe harbor table is helpful, that those rates don't always actually equate to reality for what the true cost breakdown is. And so if you don't have the cell made in the US, you still have a path, okay? Let's assume that the frame and the junction box are made in the US and have the cost figures that you see on the screen. Cost of the vendor, $60, and those are made in the US. So let's put the 60 in the numerator and in the denominator. Let's assume the glass and the other direct costs are not made in the US, so the 40 and 40 goes in the denominator there. And remember, the cells are not made in the US, so 250 down in the denominator. Now let's look at the inverters. Let's assume that all of the components for the inverter are made in the USA, the PCBA and the enclosure. So the total cost to the vendor, 150 and 250 for the inverter, going in the numerator and in the denominator. The math here shows you 370 over 700. You're at 52.8%, assuming these facts. And if you're following along for what the domestic content percentage would be for projects that begin construction in 2026, it's 50%. You're over the threshold. If your project began construction in 25, you have a lower threshold, lower hurdle to get over, and so if this math holds, you'd be good there too. And so another point to make, not only so that's the manufactured product cost calculation for domestic content. You also have to have the structural steel and iron made in the USA, and those items are not included in the calculation. Okay. And so let's put a pause on domestic content and let's talk a little bit more about FEOC. So FEOC restrictions, I could talk about FEOC for hours. I'm going to spare you all of that, and we're going to do the quick and dirty discussion. And so there are 3 important FEOC restrictions that came out of OB3. It's a taxpayer test, material assistance test, and a contract and licensing test. For purposes of this webinar, let's focus on that material assistance test. There's a ratio that's important here called the MAKER, the material assistance cost ratio. And for qualified facilities that are not storage projects, they have to get over the hurdle of 40% for projects that begin construction in 2026. What exactly is that? What does that 40% ratio mean? It means that greater than 40% of your manufactured products are made by non-FEOC entities, okay? And then that ratio, that hurdle, is going to graduate every year by 5% until it stays fixed for projects that begin construction after 2029 at 60%. Okay, so similar to domestic content, there's 2 paths to substantiate compliance. You have the direct cost approach, which is the more complicated one, where you have to actually obtain the cost for every manufactured product component, and then also understand the FEOC compliance of that manufacturer. Let's focus on the easier path for this one, the safe harbor approach, where OB3 has identified that we can utilize the IRS 2025-08 table. So let's go to the next slide, Kleber. So the safe harbor approach may be a simple path. We've all heard about how scary FEOC is, and it is. There's a lot of restrictions here and clarifying guidance that we all are excited to receive hopefully soon. But maybe there's already a simple path for us all to think about while we wait for additional guidance. That simple path would hinge on FEOC compliant cells, okay? So the table that we're looking at on the screen, this is IRS Notice 2025-08, and the table for solar PV ground mounts. We have the column for fixed tilt. This would be applicable to carports. So you can see these default percentages. What immediately sticks out is the weight put on the cells, right? So if you have a ground mount fixed system and those cells are FEOC compliant, you'd get 53.2 points towards that MAKER calculation. You're already over the 40 if you begin for a project that begins construction in 2026. Now, what you'd like to do is you would like to not only have the cell be compliant, but maybe a few of the other MPCs as well. So what if the inverter is also made in by a non-FEOC entity? That's 7.5 points, right? And so by way of example, 53.2 on FEOC compliant cells, 7.5 on those FEOC compliant inverters. You get to a maker of 60.7. If you remember on the last slide, through projects that begin construction in 2030, 60 is the hurdle. And so maybe a simple path if you have FEOC compliant cells and FEOC compliant inverters. Now, that sounds easy, but I don't want to lead you on. It is complicated to then substantiate it, but what I'm here to tell you is that Novogradac is able to provide an agreed upon procedure report. And we've been engaged by a number of manufacturers and clientele of the firm to do exactly that. And what does it look like? Novogradac would perform detailed procedures to determine if the manufacturers are PFEs. And within the PFE designation would be SFE and FIE rules. I'm going to spare you all of those complexities, but just know that what we're digging into would be the ownership information of the manufacturers. And the goal of our AUP report in that example that I just walked you through would be to obtain information from the module manufacturer, the cell manufacturer, and the inverter manufacturer to determine their FEOC compliance. And as a result of performing those procedures, the report would identify the findings that we work through that analysis. That report can then be relied upon by yourself and your taxpayer as you think about and reach your own conclusions about the FEOC restrictions for a project. Okay, so let's go to the next slide, Clever. And so by utilizing Novogradac for this agreed upon procedure report, it streamlines the process. You know, as far as the direct cost approach for domestic content, it's complicated. It can be complicated, but because Novogradac has established relationships and rapport with the various manufacturers in the industry, we have existing NDAs where we're able to obtain that direct cost information and sensitize it and work out a report that you and your taxpayer can rely upon. And as a result of leveraging those existing relationships, it becomes simpler and more efficient. And so that results in time savings and cost savings. So I'm excited to announce that Novogradac works with SolarEdge and Heliene products. And so if you have those products involved on your project, you know, I'm here to tell you we have existing NDAs, and we've found a way to make this otherwise daunting, complex due diligence analysis. We found a way to streamline that, make it cost effective, and create time savings for projects to substantiate their domestic content compliance. And so with that, I will I'll toss it over to David, and just a quick disclaimer here as well. Just want to point out that the material we're talking about here in the webinar is educational and for informational purposes only, and doesn't constitute tax advice. We love helping with these projects, and so we do hope that you reach out to us and we can provide that type of service to help get you to the finish line on these complicated tax issues. And so with that, I'll toss it over to David.
Awesome. Thanks, Josh. I'm glad we had the opportunity to do this, because I feel like, you know, there's clearly an unrealized opportunity to use the direct cost method specifically for shade structures or carports that we've been talking to clients about. And so I think this will be really helpful in educating the market and into this kind of lower cost option and solution to qualify a project for the domestic content adder. Hi, Dave Riesenberg. I'm the Chief Commercial Officer at Heliene, or Heliene. There's no correct way to say it. It's a made-up word, but the origins is it's across from Helios, the Greek sun god and energy, so Heliene, perhaps. I will say it is our most commonly asked question with clients. Last month, we celebrated our 15th year in business. We began manufacturing modules up in Sault Ste. Marie, Ontario, back in 2018, and then, I'm sorry, in 2010. And then in 2018, we entered into the US and began manufacturing in northern Minnesota, where we still manufacture today. Earlier this year, we turned on a third line in Rogers, so it's a northwest suburb of Minneapolis. And today we're operating 3 lines in the state, totaling 1.3 gigawatts of module capacity. Today we employ over 600 employees, 550 plus of those in the US. And the vast majority of our products all go into C&I and community solar, utility scale solar type projects. We do sell residential modules, but the focus for the last several years has been into the larger commercial and community solar type projects. Next slide, Clever. Thank you. On the FEOC topic, I mean, we are the kind of low risk solution, right? We're a locally owned American manufacturer, not a prohibited foreign entity, not a specified foreign entity, not a foreign influenced entity. We are your local Midwest module manufacturer. And equally as important, the cells that we use, and even when we import cells for use in our modules, we're sourcing those from non-PFE entities. So we check all the boxes there. We do have certifications available to this effect upon request, as well as certifications for the maker or material assistance cost ratio value of the products purchased. Next slide, Clever. So just a quick overview on the product portfolio, and this has been kind of simplified for illustration purposes, but we have them kind of categorized as our full value domestic module and the essential value, full value being the module with a US made cell. And so for the past 12 months now, for the past 1 year, we've now been shipping modules with US made cells. And we also include a very rich bill of material from domestic components as well. I say this is simplified because we have an approach where we actually allow our clients to determine which components are domestic and which ones are non-domestic. And so what we'll do is we'll export from our ERP our cost sheet of the bill of material and all the BOM combinations, and the customer can then pick and choose which components they want domestic, which ones they want non-domestic, based on both their domestic content and budget requirements. So 2 different form factors. We do a 144 half-cut cell module, and then we do a taller version, which is a 156 half-cut cell module. And then in each of those 2 different form factors, we can include a PERC cell, either imported or domestic, or an imported N-type cell. We still don't have an option for domestic N-type cells or TOPCon cells available here in the US. So you can think of it as kind of 4 different products using those 2 form factors and 2 different cells. Today, all the modules coming off the line can include the domestic cell or the imported cell, and then a domestic frame, backsheet encapsulant, edge seal, bus ribbon potting, which bus ribbons on their potting we didn't include, but that comes in December. Backsheet, junction box, and frame and encapsulant. So customer really has that flexibility to kind of pick out the right BOM for their product. All the BOMs have been all certified, so we're all good to go in that respect. But it does provide them kind of a custom approach to picking the right module and not overpaying for that module. Next slide, Clever. Well, back over to you.
All right. Yes. Thank you, David. Appreciate it. So just I'll go over here, right? So a few slides here on practicality, right? That we heard from Liz on policy, we heard from Josh on the mechanics of the calculation, and from David, right? Introduction on the modules. Thank you. So let's start kind of getting practical, right? Like I would say on how does that mean, right? For you. So I'll walk you through a recommended model for achieving the domestic content bonus credit in carport and small ground mount applications. So this module This model actually combines the direct cost method that was explained by Josh, SolarEdge inverters, and Heliene modules that David just explained, that the model is available in both versions that David explained, right? I mean, the full value and the essential value module options. First, here are the products that we'll be using in the model, right? The SolarEdge CNI inverters ranging from 10 kW to 120 kW and their DC power optimizer, which are made in the United States. Heliene modules, both the full value and with domestic cells, and essential value with imported cells that are FEOC free, as David explained. Our customers can use either modules or a combination of them, but next I'll show how domestic content bonus credit can be achieved using the essential value module. So traditionally, right, I mean, domestic content requirements for carport and ground mount projects are achieved using the full value modules with US made cells, right? But these modules are often limited in availability. Our goal is to offer a practical alternative path to domestic content compliance in this type of projects by leveraging the direct cost method, SolarEdge DC optimized inverters, and Heliene essential value modules, which are more cost-effective than the full value modules. This solution addresses several industry concerns. Number one, pricing. The essential value modules reduce overall costs. Module availability, because it expands the options, right, and beyond the US-made cell modules, which are largely allocated to utility scale projects. And installation logistics. Why? Because this model allows you to use one PV module bill of material, which is the essential value, to be used for the entire project. Feedback from customers is that, I mean, this approach significantly reduces supply chain risks, ensuring greater flexibility for carport and small ground mount projects. Having introduced the solution for domestic content calculation using the direct cost method, SolarEdge, and Heliene essential value modules, now I'd like to run through a couple of models that estimate the monetary benefits that this solution can unlock. The first one is for customers that are not pursuing domestic content, as they may find it complicated or think that the premium for domestic content products is too high and not worth it. In a typical carport project, so let's focus on carport project for a moment, the bonus credit is around 30 cents a watt. Assuming that the project cost is around $3 a watt, so 10% of $3 a watt is 30 cents a watt. By the way, we hear that carport projects cost even higher, but let's assume for now $3 per watt. The typical SolarEdge premium over string inverters is around 7 cents a watt, but our system provides 3 to 4 cents a watt on balance of system savings thanks to the DC optimized configuration. The essential value module has an estimated premium of about 10 cents a watt over non-domestic content modules. After factoring premiums, the estimated benefit is 16 cents a watt, which is a significant boost to project economics that can make the numbers work. Please note that these are only estimates and that pricing will change depending on the project final configuration. Let's look at a second scenario now, which are for products currently using the full value modules with US-made cells, right? So this is the scenario where customers are already pursuing domestic content bonus credit, but using the modules, right? I mean, they use US-made cells. As mentioned earlier, by applying the direct cost method with SolarEdge inverters, developers can switch to essential value modules, which are more affordable and widely available. In this scenario, similar as before to the previous one, we're assuming a 30 cents a watt for the domestic content bonus credit. Again, the SolarEdge premium is 7 cents a watt, offset by 3 to 4 cents a watt balance of system savings. By using the essential value modules, the savings can be 15 to 18 cents a watt when compared to the full value modules. This approach unlocks an additional 14 cents a watt in value, improving project economics while maintaining domestic content compliance. Beyond cost savings, this model reduces supply chain risk by enabling the use of domestically assembled modules with imported cells, providing flexibility where US cell modules may not be available. And again, please note that these are only estimates and that pricing will change depending on project final configuration. So now let's switch gear here we talked about carports and small ground mount projects. Let's for a couple of minutes talk about rooftop, right? So earlier in this year, we introduced a domestic content model for rooftop applications using SolarEdge inverters and Enstall products, meaning panel claw and iron ridge flat roof racking. That approach delivered domestic content levels above 40% under the 2025-08 elective safe harbor table. However, the domestic content thresholds have since been revised and will increase, rising to 50% in 2026 and 55% in 2027, as Liz explained. The solution we introduced early in the year combined SolarEdge inverters with panel claw racking, Claw AirFar, and Claw AirFar Plus, achieving 44.4% domestic content using the 2025-08 elective safe harbor table. Now, by including Heliene essential value modules, which contribute 0.8 to 12.1% on the elective safe harbor table, projects can meet the upcoming thresholds of 50% in 2026 and 55% in 2027. For rooftop applications, this approach leverages the elective safe harbor method, enabling the use of essential value modules, offering lower cost and greater availability compared to the full value modules. And here, quickly, right? I mean, we show also the model. I mean, previous, like I mentioned, we also showed them two models with two racking systems, one with panel claw and one with iron ridge. Here I'm showing the solution with SolarEdge inverters, iron ridge BX racking, and then Heliene modules, essential value module, that is. So it's the same method and the same solution, right? Yielding the same results, but with a different racking system. And with that, I'll call Corey for a quick update on Enstall.
Thanks a lot, Kleber. Yeah, we've covered a lot of material today. I think all I really want to do is let folks know that from a flat roof standpoint, Panel Claw and Iron Ridge have three systems that are available to you that can help you meet both the 2025-08 standards for the domestic content bonus credit, as well as FEOC compliance. A little bit of background there on the Claw FR system from Panel Claw and on the BX system from Iron Ridge. We actually have products where the materials themselves are made in the United States. So Panel Claw's system is made primarily from steel, and all of that steel is melt-through coat American steel. In the case of the ballasted platform from Iron Ridge, BX uses Ultramid, which is a glass-filled polymer made by BASF, and we source the polymer from BASF in the United States, and we create the chassis and the clamps themselves in the United States, the chassis in California, the clamps in Ohio. So if you're looking for a high level of assurance for products that are bona fide fabricated in the United States using US materials, both the CLAW-FR Plus platform and the BX platforms provide you with a very high level of assurance. In the case of the tilt mount solution from Iron Ridge, which is not a ballasted flat roof solution, it is a fully attached solution. The structural fasteners and the rail components that correspond to those pieces in the 2025-08 notice in domestic content and is also applicable for FEOC. All of those products are also available in a domestic content, meaning manufactured in the United States version. And in many cases, those same products, if you choose to go with something a little more economical, can be sourced FEOC free as an imported product as well. So we offer a wide variety of solutions with a high level of confidence that the products that you are getting meet both FEOC compliance rules as well as domestic content bonus credit in the case that you're wanting to go for that as well. Thanks, Kleber.
Thank you, Corey. And then just as a last slide here before we turn it to Q&A, here are the next steps, right? I mean, if you're interested in learning more about the solutions we discussed today, Novogradac has created 2 letters explaining the solutions, one for rooftop and one for carport and small ground mount. Please reach out to your sales representative from either of the companies here, Heliene, SolarEdge, or Enstall, and they will share the appropriate letter with you. You can also contact me directly, and that's my email address right there, and I'll make the proper introductions. Okay, so with that, we covered a lot of material, and I know there are lots of questions, right, I mean, already coming in, and we have a few minutes here to have a Q&A session, so I ask all the presenters to come back on video, unmute themselves, and then go through a few of the questions here. So there are several questions, and any of the questions that we do not answer today, we'll do our best to answer in the next few days. We'll contact you directly. Okay. All right. So there are questions here about safe harbor, about the direct cost calculation, FEOC. So I'm going to try to combine them together, but let's start with safe harbor. Liz, there's a question. Is there still time to safe harbor projects?
Yes, absolutely. So let me point out a couple of key windows here. So again, projects that safe harbor by beginning construction on or before July 4th, 2026, that locks you into the 4 years to be able to complete those projects and still receive your credit. And then projects that safe harbor by beginning construction after July 4th, 2026 must place in service by December 31, 2027 to receive the credit. There's a couple of additional safe harbor windows in there during the time, because remember, when you safe harbor, you're locking in the regulatory requirements at that time. So for example, if you were to safe harbor before the end of 2025, you're locking in your 45% domestic content threshold. Or, for example, if you were to do it at the beginning of next year in 2026, so in January of 2026, if you safe harbored then, you would be locking in 50% domestic content threshold and 40% non-FEOC threshold. So absolutely time to safe harbor still.
Sounds good. And then just kind of like a question for everyone here, for Josh, David, and Corey. I'll start with David. David, are you seeing an increase in safe harbor deals?
Yeah, we went through a bit of a round, 6-8 weeks ago, and now we're entering into kind of another period of safe harbor. It won't be as big as we saw on the last round. Coming up at the end of the year, people trying to preserve the domestic content threshold, or maybe they're just trying to de-risk FEOC. But the big one will be around the corner, and probably second quarter time frame, heading towards that July 5th deadline.
Corey?
Indeed, yeah, we're seeing a lot of activity right now. It really started to pick up starting in about August, once we had the additional clarification on FEOC rules that Liz was mentioning earlier in this talk. it's been a steady increase ever since the August timeframe. We're seeing people not only using the 5% rule, but we're also seeing an uptick in projects that are trying to use the physical work test as well in certain cases with our CLAW-FR racking.
Very good. And Josh, I mean, I think that you're also kind of helping customers, right? You're seeing an increase on that.
Absolutely. Yeah. I mean, it's never been more important, right? The stakes have never been higher. The physical work test and 5% safe harbor aren't new. This has been around for a while and has been utilized for a lot of different reasons, especially when the tax credit percentage was, dropping. But right now, it means everything. It means whether or not you need to be FEOC compliant, or it also could determine if you get a tax credit, right? So if you don't begin construction, like Liz said, before July 4th of 26, then you have that 2027 cliff for placement in service. So you're motivated to begin construction before that date and before the end of this year to avoid these complicated FEOC restrictions that are lacking clarity and guidance. So it's probably the thing I'm talking about the second most with my clients, second most to FEOC. So a lot of strategies that folks are honed in on and perfecting.
So David, this one is I think this is for modules, right? I mean, so let me ask. It's a long question here, but so developers and installers working on rooftops and carports are concerned about availability of US-made cell modules, which is what introduced the full value module. US-made cell modules are being used extensively in ground mount projects, leaving little capacity for other segments. Can you please talk about this trend and what Helene's manufacturing capacity is for both the essential and the full value modules?
Yeah, so let me unpack that a little bit. It's a good question, and it is true. Demand for our U.S. manufactured modules has been strong across the board. Both the imported cell and the domestic cell versions. Honestly, I see a lot of the U.S. cell product going into commercial rooftop, carport, and fixed tilt ground mounts. Not necessarily all getting scooped up into single axis tracker projects. Many of our customers will mix and match, right? They'll take a lower cost product, whether it be our imported module or the essential value module, and they'll blend in a certain amount of US cell modules to bring up enough content while keeping the ASP of the module as low as possible. We also see people using two US made modules, one with a US made cell and one without. So there's different kind of mix and match options that our customers are going with, but it is a very common kind of procurement strategy that we see. The good news is we still have capacity available in 2026 for all of our module types. And, on the domestic manufacturing side, we're really going all in and kind of moving farther up that value chain by allowing access and building modules as early as the first quarter next year with US made poly ingot and wafer through the Corning Hemlock agreement. So we're really excited about that. But for carports and rooftops, like the good news is you don't need a US cell to qualify, right? For the domestic content bonus, using this direct cost method, developers can save a ton of money. And so again, I'm glad that we're talking about this today. In often cases, you don't even need to mix and match. You can just go with one module, one BOM, and you're there.
There you go. And I think also there's a follow-up question. What is the lead time here for the two modules? Ballpark.
So lead time's driven entirely by the status of our production queue, right? We're running PERC on one line, and we're running N-type modules on other lines. Right now, if we were to look at that, the first availability would be late Q1, call it March timeframe for new production. That said, last week we had a customer cancel, and there's currently roughly 8 megawatts of finished goods sitting on the shelf. So if anybody's in a pinch and needs product immediately, like we have that essential module in Minnesota ready to go.
All right. Very good. Okay. Corey, just a quick one for you. On the Enstall side, any concerns to ramp up manufacturing to meet demand for domestic and FEOC compliant equipment?
No, none at all.
Right. And then I would just kind of also from a SolarEdge perspective, right? I mean, I think that also mentioned that, yes, we're ramping up. We have a manufacturing facility in Florida, and has already been ramped up for inverters and optimizers. That's Tampa in Florida. And we're shipping inverters, and we plan to meet the demand for domestic content FEOC compliant equipment. Okay. Liz, quick one here for you. Can you provide any guidance with regards to updates on FEOC compliance guidance?
So I think everybody is asking that same question, right? So and what I can say is, we understand that they're definitely working on additional FEOC guidance. We think that they may provide some light guidance by the end of the year, and then possibly notice a proposed rule later in 2026 with possible final rules at the end of 2026. But to be clear, the timeline is not fully known, and wouldn't be surprised if it gets delayed, as I said in the beginning, because of the government shutdown and other actions that they need to be taking. So we think we may see some at the end of this year, beginning of next year, but certainly more to come on beginning of construction guidance. I'll just say, because that question has been out there as well. We think the Treasury was very clear in their August notice, the 2025-42, and therefore we don't anticipate anything further coming on beginning of construction.
Thank you, Liz. Thank you. Josh, I have a couple for you here. Direct cost, right? I mean, us direct cost, and also with carports and small ground mounts, right? Is it possible or acceptable, right? I mean, to do the direct cost calculation using modules and inverters only? The person that's asking here this question said that I thought every single component in the project needed to be included in the calculation.
It's a really good question. And the guidance that we have right now doesn't specify, but what we have in the guidance is we have safe harbor tables, and we have tables that identify the MPCs, right? And so when you're looking at the safe harbor table, I like to call it the big three. You have the modules, you have the inverters, and you have the tracker that are included in the safe harbor table with the default percentages that add up to 100. So what is the IRS telling you there? They're telling you that these are the three major manufactured product components that make up the cost of a system. Okay, and so one interpretation to that would be that when doing the direct cost calculation, you should use those three manufactured product components for the calc. And the industry accepts that's what a lot of my clients in fact do. And for carports, there's no tracker, right? So the big two modules and inverters for that purpose. Now, I have a lot of clients that say, but surely there are other manufactured products, right? There's transformers, there's switch gears, there's wires, and so they're not wrong when they say that. And so those folks have taken a position to gather the direct cost for every single what they deem to be manufactured product, and that's fine too. I see that accepted in the industry, and so I think both paths are tried and proven, and you have merit to take a position either way. It's up to your risk tolerance or your interpretation of the guidance.
Gotcha. So then I think you'll confirm there is a question here, right? I mean, that what other equipment can be included in the direct cost calculation, right? I mean, for carports, for instance, transformers, switchgear, cable. I think that's what you mentioned, right? I mean, that this is something depends on it, either path is plausible for you. Is that correct, Josh?
That's right. Yep, that's right.
Okay. All right. Question. Can you explain why the carport structure, especially the purlins, may not be considered in the direct cost calculation?
Got it. Yeah, good question. So the purlins and any carport structure would be viewed as structural, okay, not necessarily manufactured products. And what's a little bit tricky is that, you know, we have these tables for ground mount solar, for rooftop solar, but there isn't a table for carport structures, right? But there is guidance that made it clear that the carport structure fits in with ground mounts, okay? You'd love there to be direct clarification that tells you what to do with the purlins and the structure of which the panels are sit atop. But I would say that, you know, when you look at the guidance for a ground mount, it's easy to draw the parallel that, you know, that structure is similar to the structural items for a ground mount system, and the guidance makes it very clear that any steel and iron that's part of those structures would fit into that 100% structural steel and iron test and not included in the manufactured product test.
Got it. Okay. Few others here for Josh. I think, Josh, you're the man. So what is your guidance for a project that includes both carport and rooftop? What method should I use?
Another really good question. So I sound like a broken record when I say I wish we had more guidance on specifics like that. You know, so again, you wish you could go the safe harbor route for all of the things, but you know, there isn't a table that shows how to blend or what to do with blending such a situation with rooftop and carport, right? So what I advise my clients to do in this situation would be to go the direct cost route, right? Because you don't have the default percentages in the safe harbor table to lean in on, or who knows what an appropriate allocation would be between, you know, the carport and rooftop piece. So maybe there's a way to do the safe harbor table, but little complicated and hard to get everyone to agree on how to do that. What is clear would be the direct cost approach, right? If you can obtain the direct costs for the carport structure and all of the manufactured product costs, if you will, you know, there's not ambiguity there. So I would advise, if you have that situation, go the direct cost route, because that's a lot more clear.
Gotcha. Okay. We're running out of time, but there are two other questions that I want to cover here. First one, I think will be the second to last. FEOC compliance, right? So I think this is for you, Josh. Would you please explain again how the elective safe harbor tables can be used for FEOC calculations? You could just do like a quick 1 minute.
Yeah, right. So the safe harbor table for FEOC could be used such that there's default rates, okay, and you have that maker ratio, and what you would do there is gain an understanding as to the FEOC compliance of the manufacturers of those MPCs, and once you gain an understanding there and a confidence in their FEOC status, if they're a PFE or not, and say they're non-FEOC, then you would count the default points in those tables towards that maker ratio, and that's the approach you would take there. Very similar to domestic content, right? And we're able to use the 2025-08 tables until they come out with tables specific to FEOC, which they have a goal of doing that by 12/31/26. But as we know, FEOC compliance is relevant beginning on 1/1/26. So it's good that they were so thoughtful to reference the 2025-08 tables for us to use in the meantime.
Sounds good.
And hey, Josh, can I just add one sentence to that, just to say that with the 2025-08, that what H.R.1 articulated is that we can use that table until 60 days past the Treasury gives new guidance. So just to give a little bit more comfort too, that there's a little cushion once Treasury does come out with new guidance.
Sounds good. And then there's, I think, a generic question I'm going to ask for everyone. And I start. So what's the contribution, right? I mean, for each of the equipment for FEOC calculations, right? So I start with SolarEdge inverters. On the carport and ground mount fixed, we contribute 4.7%, right, for the FEOC calculation. and 24.8% for rooftop MLPE. So I'll pass the baton now to David. David, what contribution on the table, right? I mean, for FEOC calculations that you're guiding the customers.
I don't have the numbers in front of me. It would depend on the project type, right? What type of project they're building. We do have FEOC certification in hand and can draft any sort of mark or material assistance cost ratio certification with the purchase of any module.
Okay, sounds good. Corey, what's your guidance?
So it's a little tricky, I think, Kleber, in terms of when you talk about using the safe harbor table for FEOC versus domestic content. One of the things that's really clear in the domestic content guidance 2025-08 is that the production benefit you get if you can run the stack for inverters or modules or racking. In the case of racking, we only have two manufactured product components that we have to worry about: structural fasteners and rails. I think if we stick to just the MLPE version, if you include that production credit bonus, you can get up to 19.6 points that we can contribute with any of the three solutions that we were talking about a little bit earlier. I know that some people are consulting with their counsel, which, Josh already said this, but I'm going to say it again. Remember, folks, we're on a webinar talking about the possible, but you need to make sure that you're getting your own advice from your own trusted advisors with regard to the strategy that your company is going to take, or your customer who might be the taxpayer, and what strategy they're going to adopt before you run off with any of the numbers that we're giving you here today.
Very good. Sounds good. And then as a last question, I just going to go quickly here with Liz, David, and Corey. The question is, are your companies issuing documentation for FEOC and PFE requirement compliance? Liz?
Yes. So for SolarEdge, even though FEOC doesn't come into play till January 1st, we have already been working, and I should say, not only that, but we are assuming we're going to receive some additional guidance from Treasury, right? So with what we know today, we've been working with inside and outside counsel to develop the SolarEdge certificates. So we are a non-PFE, and we have a certificate that says that. And we have developed certificates that includes our non-FEOC percentage, which you've heard Kleber talk about in terms of what percentage we're saying we can provide from the IRS 2025-08 table. And then I'll also share that some of our customers are coming up with their own, sort of Excel spreadsheets for us to fill out based on what they understand from H.R.1 as well, and we're working with them. So the answer is yes, we're very happy to work with our customers to provide what's needed on this. I'll pass it to David.
Yeah, we have the certificate in hand, so happy to provide those to any clients who need them. Those will then be backed with certificates from all of our component suppliers. So it's a back-to-back certificates, so not just from our company, but also from all of the companies supplying the components in our product.
And David, that's a really important point. So let me just add, from a SolarEdge perspective, we do have third-party manufacturers that we utilize here in the U.S. So we're the manufacturer with our third-party manufacturers, and utilizing, again, 2025-08 table, all those manufactured product components that are in there that we're manufacturing. We also will include those in our letters. Sorry, Corey, I'll pass it to you.
No, this is great. And I think one of the reasons why Enstall was so happy to have an opportunity to get on this particular conversation is because both SolarEdge and Heliene have gone to a lot of effort to provide a good level of transparency and some good documentation to back up their claims for where they're actually manufacturing things. And I want to warn the listeners that a lot of people are going to say, yeah, we can do it. But once you scratch the surface, it may not provide quite the same level of thoroughness to the homework that's been done. And so I guess before I state what we're doing, I would like to remind the audience that, remember, all of this comes down to a taxpayer wanting to take a tax credit, and they may or may not try and monetize that tax credit. But at the end of the day, the taxpayer is ultimately bearing the risk for claiming that tax credit. And this comes down to risk tolerance for everyone. And the great thing about working with Heliene or working with SolarEdge or working with Panel Claw and Iron Ridge is that we've really sweated those details. We actually do fabricate in the United States. We don't just wave our hands at the word fabricate and claim some other things that we can do instead that are just as good. We actually can point to factories in the United States where we're actually building these things. And we've gone to the trouble to prepare ourselves over months to make sure that we have supply chains that are going to be resilient in the face of what might come down the road in terms of additional raising of the bar on FEOC or even, God forbid, the domestic content. Remember, we've got one more jump up to 55% here before too long that we need to be prepared for. We provide similar documentation. We provide it to commercial EPCs for the benefit of their customers who are the taxpayers. We provide all of that under NDA. We've also done the work with Novogradac to make sure that they know every place we're building the products that we claim for the tax credit. So please, look us up, and we're happy to help.
Very good. All right, then with that, I think we are beyond our time here. So I appreciate everyone. Thank you, Liz, David, Corey, and Josh for joining us. This was an amazing opportunity, right? I mean, to explain to everyone this complicated but yet achievable topics, right? I mean, so I think that as Corey mentioned, we're here to help everyone and reach out to us. And so thank you very much. Thank you all. Bye-bye.